Pro number 3 will be the fact that dividends are going up. So over the past 5 years, the dividends has gradually gone up.
Welcome to another episode of Stocklist. Today we're going to talk to you about Home Depot. Yeah? So, I'm going to go straight in. Home Depot is the US's largest home improvement retailer. They compete with the likes of Amazon, Walmart, and Target, right? In the past year, their share price has gone up over 25%, and in the past 5 years, it's gone up almost 146%.
That's a lot. That's a lot.
That's
in 5 years,
that's
a
high
lot.
growth.
Yeah, very high growth.
Their current ticker is HD. They're listed on the New York Stock Exchange, and the price is $312 as of recording today, the 22nd of
June.
That's it.
And the 52-week range is $240 at the low end, and on the high end is $345. So at the moment, you can see that their share price is a bit too high.
A bit close to the 52-week range high.
That's it. Something we always talk about as well. So revenue in 2020 was 110 billion, and it went up by 22 billion to 132 billion in 2021. However,
after all that revenue, they were left with a profit of 11 billion in 2020, and that only went up by 1 billion in 2021 to 12 billion.
That's it.
It's very simple. So you can see that to bring in over 100 billion in revenue, the cost must be exceptionally high to only bring in a profit of about 10%. Yeah,
That's it.
That's crazy.
So before we go into the pros and cons, just a quick disclaimer to let you know that we're not financial analysts
Nope.
or advisors.
Nope.
Take everything we say with a pinch of
So,
Maggie,
paprika,
and anything else in the kitchen.
All right, let's go.
So, pro number 1.
Right, so pro number 1 was the stimulus checks that the American citizens were provided with. Obviously, that helped to bolster the sales and the profits of Home Depot.
Yeah, the more disposable income, the more people are going to use
To spend.
to spend.
Buy
Yeah.
bits and bobs for the home, little bits of home improvement stuff, new carpet, all of that.
Top of the fact that there's more time
Yeah.
for people who weren't previously at home.
Yeah.
Able
People
to
are
do
spending a lot more time at home.
Exactly.
Right, so pro number 2 is the fact that lockdown has been easing and people are now allowing more professionals to come into their home and do up their homes. For example, people are having more decorators come in and paint. People are having maybe more plumbers come in and sorting out their sinks and stuff.
Yeah.
So, yeah, it's just the fact that people are more comfortable to allow tradesmen into their homes. Very simple.
You know, when tradesmen come into your house, they're buying everything that they actually need to do the job. They're not doing a quick job.
Exactly. They're buying the items from Home Depot.
Exactly.
Home Depot revenue, profits go up. Simple.
Simple as that. Pro number 3 will be the fact that dividends are going up. So over the past 5 years, the dividends has gradually gone up. Last year was $1.50, and this year is $1.65 per share. So just over $6 annually that they're providing in dividend payments, which is quite high. If we now move on to pro number 4, pro number 4 will be the fact that holiday season is coming up. With holiday season coming up, that means a lot of people are going to be doing not only indoor home renovations, but outdoor. Lots of people want barbecues, the likes, so they want to make sure that their garden is
well patterned.
We'll
start off with the cons. And con number 1 is the fact that the stock price is currently trading very, very close to the 52-week high. So the current stock price is 312 and the 52-week high is 345. The low is 240. So you can see the gap. The current price is very, very close to the top, and that could pose as a potential issue. The second con is the fact that currently house prices are booming, the housing markets are rising, and inflation is going to come about naturally because of this. Therefore, the Fed are going to want to regulate this by increasing interest rates and dampening the boom in the market. So that will definitely affect Home Depot stocks, as less people will be buying homes, less people will be making changes to their homes, as there'll be less movement in the house market.
And also, that's because there'll be less money for people to borrow from the banks as well.
Exactly. So higher interest rates means people are going to be less likely to borrow money because it's so expensive to borrow. And obviously, there'll be less mortgages as a result of that. It's that simple.
That's it. Con number 3 will be the fact that their debt has increased from 26 billion to 41 billion over the space of a year. Well, 2 years, sorry. Yeah, that's just mad. It's actually crazy. The fact that the debt has increased, some may see it as a positive simply because they're using the debt to grow the business. However, it's almost doubled.
Yeah.
Not quite doubled, but it's 41 billion
Yeah,
from
yeah,
26 billion
It's actually
it's
quite
still
high.
quite high.
Yeah, definitely quite
So that's
high.
something to look out for when you're considering whether or not to invest in this company.
That's it.
Con number 4 will be the fact that they have recently taken matters into their own hands. As you all know, we're currently in a global pandemic at the moment, and with increasing COVID rates in China at the moment, is going to cause a delay in shipments from China to the US.
Yeah.
So what they've decided to do is charter their own ships back and forth
Yeah.
to prevent a delay in supplies going out to customers.
Yeah, yeah.
Obviously, they need to stay ahead of the competition. So this is the best way to stay ahead of their competition by chartering their own ships.
Yeah.
If we now consider all the cons, all the pros, is this a buy? Do you have a stake in the company? What's your final thoughts?
So personally, I don't currently have any shares in the company, but to me, it does seem like it seems like a long-term buy. Obviously, because of the whole 52-week high situation, I wouldn't say buy now, but definitely it's something that you can definitely keep on your watch list. And at some point, when it does dip, because I do believe it will dip a bit further, you can buy it maybe in the high 200s. Yeah.
For me, I definitely think it's a buy for the future, not a buy right now, simply because, like you said, the price is too high.
Yeah.
I've got shares in it, but I bought it last year because I knew last year that we were stuck in a pandemic.
Yeah.
Stuck indoors, couldn't do nothing.
Yeah. So we had to...
You renovate your yard somehow, even if it's your garden, whatever it is.
You want to do something in your house.
You want to do something.
People are working from home.
Exactly.
People are buying office equipment for their houses.
My mistake is the fact that I didn't buy a lot of shares.
Yeah.
So when the price drops, I'm going to buy more shares so that I can reap the benefits of the dividends. The dividend payments
Quite high.
It's quite high over the course of a year, over $6. So yeah, it's definitely worth buying. And my second point I'll say is that the housing market is like any other market. There's always peak periods and there's always low periods.
Yeah.
So this is a stock that you just need to hold long term.
Yeah, I definitely believe in that. Yeah. So for you, Sabai, what's your rating?
My rating will be, I'll say 4 out of 5, but not a purchase at this price, simply because it's too high.
Okay. Yeah, and mine is definitely, it's a strong business, so I would definitely say it's a 4 out of 5 for a long-term purchase.
Like always, please like the video. It helps with the algorithm.
Yeah.
Please share it with a friend.
Yep.
Please share it with your dog, your cat, whoever you can share it with, share it with them.
Have a party in the comments.
That's it.
And we'll see you on the next one.
Thank you.
Thank you.